Hey guys, welcome back to Sky Talks Trading. My name is Sky and I am on a quest to invest, and today we're going to be talking about PLTR Stock, Palantir. Haven't talked about it for a little while, but better late than never. And then after that, we're going to be talking about 3 stocks that maybe you could consider buying. I'm not a financial advisor, but these are 3 stocks to maybe add to your watch list. So first of all, though, let's talk about PLTR stock. Is it still a good investment for 2022? Earnings season. It is here in full force, but continued sell-offs in the stock market have some investors doubting their portfolios and, really feeling quite flabbergasted. And PLTR, the big data analytics company, did report strong earnings, but the stock has not been performing very well at all, down 11.71% in the last month, picking up a little bit now in today, up 4.56%. Definitely, there's no doubt about it that Wall Street skeptics have been a little bit critical of Palantir, well, kind of a lot, labeling it as a company that relies too heavily on government contracts and has not established a strong foothold in the private sector, compared to other companies, their peers, such as Snowflake. For the fiscal year of 2021, Palantir generated $1.5 billion in total revenue. Nearly 60% of this was attributed to government contracts, while the other 40% came from the commercial sector. So I think that's not bad, 60-40. Although the majority of its revenue base did come from government business, Palantir has made some very exciting progress in the private sector. For instance, in early 2021, the company announced strategic partnerships with IBM and Amazon's cloud business, Amazon Web Services. And, investors can really see that these alliances are beginning to pay off and bear fruit. The company's US commercial customer count quadrupled from 17 at the end of 2020 to 80 by the end of 2021. So, quadruple. That's pretty good. When accounting for international customers, Palantir's private sector customer count increased over 200% from 49 total commercial customers in 2020 to 147 in 2021. And I think what's even more encouraging and impressive is Palantir's ability to retain its customers. We talk a lot about customer acquisition, but how much do we actually talk about customer retention? For the first time since it became a public company, Palantir disclosed its net dollar retention rates. And if you don't know, a net dollar retention is a metric used to reflect how much revenue has grown or shrunk over a certain time period. So for the commercial business, the company's net dollar retention was 113%. Since this is over 100%, that obviously implies that the company is expanding this segment. We've also heard the saying, cash is king. In addition to this very strong ratio, the company's government business reported net dollar retention of 146%. And this in particular is very encouraging for investors because it implies that the company's revenue growth is far exceeding any churn it may be expecting. Palantir generated an operating cash flow of $330 million for the 2021 calendar year, compared to negative $297 million during the prior year. So this increase in cash flow positively impacts the company's balance sheet for sure. As of December 31st, 2021, Palantir had $2.3 billion of cash while carrying no debt. That's a pretty healthy balance sheet, if you ask me. And during the same period in 2020, Palantir had $2 million of cash and nearly $200 million of debt on the balance sheet. We need to keep a close eye on valuation. Although the company grew its top line over 40% in 2021 and has committed to 30% growth or more over the next 4 years, its revenue stream is fairly difficult to predict. And Wall Street's concerns over PLTR stock's reliance on large deals with a finite number of customers, with particular dependence on government contracts, can make its revenue flow somewhat unpredictable. But life is unpredictable, guys. don't let that scare you. Speaking of unpredictable, I mean, following the company's amazing Q4 results, the stock price hit a fresh 52-week low. You know, the bear case from the recent earnings was a slowdown in government spending, namely Gotham. But with what has transpired in Ukraine, the absolute opposite will happen. All NATO countries are likely to take on Gotham and more. You know, it's just a matter of time before the announcements of new military contracts are announced, and not only for the USA, but also for Europe. Also, Berkshire Hathaway's NetJets buying 150 Lilium aircraft, one of Palantir's SPAC investments. That seems pretty bullish. You know, when Karp said PLTR was built for bad times, he meant more than just the balance sheets with no debt and $2 billion in cash. The current times that we're going through right now makes PLTR's software capabilities around supply chain management and material sourcing / material substitution that much more, relevant and critical to a company's success. More and more, be it chips, base metals, steel, lumber, or whatever it looks like, we're living in a world of shortages, wide price swings, and complex logistics for getting required materials. Companies that can find what they need and get it first at the right price for their bottom line will succeed over those that can't. So, that's where PLTR will come in and save the day. And if you add to this the renewed focus that the Ukraine situation has put on Western defense spending, and you have a number of, very good tailwinds for PLTR stock. That's not to say that there won't be some bumps on the road ahead, as governments tend to be slow at reacting, and companies realize that they need to change how they do business and need new tools for the future. To me, it looks like the market is missing this and has lumped PLTR with the rest of the once high flying NASDAQ. So I'm still bullish on PLTR stock, but I do want to hear what you guys think. Now, let's talk about those 3 stocks. Firstly, we've got 2 growth stocks. The first one is Scalar. That's ZSCLER. And they specialize in network security. So it's a cloud platform, a secure access service edge, SASE, and it spans 150 global data centers, acting as a checkpoint where web traffic is inspected and business policies are enforced. In doing so, Scalar accelerates and secures employee access to critical applications and infrastructure, enabling users to connect to corporate resources and the open internet from any device or location. More importantly, as the largest security cloud, Scalar has achieved significant scale. Its platform inspects over 210 billion web transactions per day, and it leans on artificial intelligence to identify and prevent attacks. That results in a network effect, with each client bringing more security signals to the platform. And then when a new threat is identified, they can instantly block it across the entire ecosystem, meaning each additional client creates value for every client on the platform, which is very cool. Gartner, a research company, recently named Scalar an industry leader, citing a greater ability to execute than any of its rivals. Even better, that marks the 11th consecutive year that Scalar has been recognized as a best-in-class solution. Also, they have very impressive financial results. Over the past year, revenue climbed 60% to $859.6 million, and free cash flow surged 145% to $196.3 million. So it is definitely a unstoppable growth stock to look into further. The next stock I want to talk about is Okta. Now, Okta specializes in identify and access management, which is a branch of cybersecurity that seeks to securely connect the right people to the right technologies at the right time. Its platform integrates with over 7,000 applications and infrastructure providers, allowing clients to enforce contextual access policies based on a user's identity, network, device, and location. Okta also leans on AI, artificial intelligence, to identify the risk associated with each sign-in event, thus creating a network effect that makes its predictive engine more accurate over time. What's really interesting is 2 of Okta's greatest assets, and that are the breadth and independence of its platform. Okta provides solutions for both customer identity and workforce identity, and its software isn't associated with any specific infrastructure provider. That differentiates the company from Microsoft, which offers its own IAM product, which is Azure Active Directory. Forrester Research recently recognized Okta as the industry leader, citing a stronger current offering a growth strategy than any rival. And again, they also have very impressive financial performance. And in 2021, they announced 2 new products, identity governance and privileged access. So big things coming ahead, very strong fundamentals and upcoming catalysts. The last stock I want to talk about is Petco, actually. Ever since the news of the Omicron variant of COVID-19 came around in like late November, Petco's stock, which is Woof, kind of plummeted. However, this does not negate the growing numbers of new pet owners since the start of the pandemic. For instance, I became a pet owner accidentally before the pandemic. Yeah, she turned out a bit odd, but I love her. Anyway, the pet retailer and services company is expected to report its quarterly earnings on March 8th, which is tomorrow. And Zachary Fadem of Wells Fargo anticipates very good upside. He believes that Wolf will beat Wall Street's consensus estimates, and he argued that there is no lack of opportunities for long-term monetization. He said that demand within the industry is very strong and that Petco's stock is largely overlooked by investors. He rated Wolf a buy, and he assigned a price target of $30. So yeah, definitely some food for thought there. I hope you guys enjoyed this video. Let me know if you want more videos like this where I talk about more general stocks that you might not hear talked about every day. And until next time, guys, have a great day.